Hi everyone, and welcome to the Sustainable Finance Research Seminar this week. We have Toan Huynh from Ho Chi Minh City, University of Economics in Vietnam with us. He's going to present Going Green When You Are Pinned, Do Climate Action Plans Work, Evidence from Chinese Firms. We're really happy to have you here with us. Before we start, please keep your microphones muted. Unless you have a clarifying question in between, you can just unmute yourself and ask the question. If there are longer questions, please refer to the end of the session, the Q&A, and we will record the session. And without further introduction, I want to hand over to our guest speaker, Toan. It's really nice to have you here with us. And the floor is yours.
Yeah, thanks, Linda, so much for your nice introduction. So, hello everyone. Actually, good evening from Vietnam side. I also have thanks a lot of my co-author Khánh Hoàng also from New Zealand. He also wake up at 3 a.m. today, also joined the seminar. So today I'm very happy to present the paper Going Green When You Are Pink, Do Climate Action Plans Work? My work were carried out with Khánh Hoàng, Cường Nguyễn, Hà Giang, and I. Then my talk today will be structured with introduction, hypothesis, research design, empirical findings, and conclusions. So on my hand, also the paper and pencil. If you have any questions or any suggestion, please feel free to interrupt and ask me. And also, I'm very appreciative your comments and feedback. So let's go to the introduction. Let's go with motivation. Why we are motivated to carry out this study. So the first one, if you take a look on the screen, you also see that the sentence from Times like climate is everything. And on the right side, you also see that this is like the China map. And China is the let's say the highest heavy emitters in the world, that they produce a lot of carbon dioxide. Then every country in the world, they are committed to cut down the carbon dioxide via some protocol and also agreement. Then that's it, we also see that ubiquitous climate change happen in everywhere in the world. Let's go with why does carbon risk matter? So what is carbon risk? From Wing and Pham 2020, carbon risk can be defined as financial vulnerabilities of the businesses associated with the transitions from the fossil-based economy to lower carbon one. Then when the firms fail with the carbon policy uncertainty, it means, for example, the government, they are committed to reduce the carbon emissions. And also this is based on the carbon policy uncertainties. Then when the government, they want to reduce, they use the specific risk on the business to, for example, to firms, because some firms doing business in manufacturing industry, they also consumes a lot of energies, and also they are related to carbon industries. Until now, human beings have two international climate accords, the Kyoto Protocol 1997 and Paris Agreement 2015. Then while the literatures look at Kyoto Protocol 1997, but what happened with Paris Agreement is quite new, because now we are studying in 2021, but actually the literature related to Paris Agreement is quite new. That's the reason why we, in this paper, we look at the second one, the Paris Agreement, with more stringent policies and with more commitment. Then I would like to highlight the terminologies heavy emitter firms. Heavy emitter firms will be defined later that, but we want to ask the questions. If the government, they raise the policy that, they want to reduce the carbon emissions, and how the firms, they respond to this policy, they move away from the car operations, or they invest in the new technologies to respond the increased carbon risk. But how? So can you take a look on the graph here? So China is also like very high, the top 5 the carbon emissions over the periods from 1992 to 2014. And you also see China also the top of carbon emitters. Then I would like to go to explain how our study looked like. So in this study, we look at the event in June 2015. That's the climate action plan submitted by China to UNFCCC ahead to Paris Agreement. That's a very strong commitment. What I want to say is like more stringent policies that China want to cut down the carbon emission. They want to keep their face in the international accords related to environmental policies. Then in this study, we want to see how the Chinese heavy emitters, this is like some Chinese firm react accordingly. Then we formed the hypothesis that the more stringent policies, the stronger reactions. Then in this study, we found a reaction after June 2015, the diversification strategies from the Chinese firm is very pronounced. Then we also find 3 mechanisms: stay ownership, corporate innovations, and assets liquidation values. So let's go detail with the summaries of the key findings. So after China submitted the Paris Agreement, we found the higher adoption of diversification strategies to hedge the increased carbon risk from the Chinese firms. We also found that like more diversifications from equity firms. It means they have the less diversification discount. So that's the reason why they have higher motivation to diversify. And the third one that I want to highlight is the higher level of diversification in pilot carbon market zone. So what is pilot carbon market zone? I will explain later. But this is like several places that they can trade the carbon trading scheme. Then in our study, we found that the state ownership companies, they have the stronger motivation to diversify their revenues. Then we also found the moderating role of corporate innovation in the relationship between the diversifications and carbon risk. And the last mechanism first is the assets liquidities, right? The diversification decision. So this is very overview for introduction in 5 minutes. Then now we go detail with our hypothesis. Why we want to construct the hypothesis to test the effect. The first one is carbon risk and diversifications. So, you know, like in the current literatures, many studies, they look at how the environmental policies, they can shape the corporate decision making and also corporate outcomes. This is the vast of literatures. Then some study, they found that like carbon risk, they mitigate the firm's performance. They also reduce the financial leverage related, because like financial leverage also raise kind of risk to the firms, and carbon risk also reduce that kind of risk to the firms. And carbon risk also requests higher demanding compensations for the investor if they invest in the companies that are emitted to more carbon to environment. Then we also found the heavy emitter as subject to the high exposure to climate change and carbon risk, especially after the international carbon reduction agreement. So, but there is no study look at like diversification. Why diversification is matter? So let me explain. Because like, for example, if China submitted their plan to reduce the carbon emissions, then also some firms in China, for example, they are doing business in manufacturing industry, they cannot to emit the same carbon emission, the level of carbon dioxide into environment anymore. So that's the reason why the Chinese firm, they need to think the strategies, how they can diversify their revenue to maintain their operation. It means diversification strategy into less carbon intensive operations. So that's the reason why we try to form the first hypothesis. Ceteris paribus, firms with higher carbon risk tend to pursue diversification strategy during the Paris Agreement. What I mean is after 2015. Then the second hypothesis is the role of emission trading scheme. So, in China is like the country, they try to design the carbon trading scheme to reduce the carbon emissions. Then you also know that like there are 7 pilot carbon market zone in China: Beijing, Chongqing, Guangdong, Hebei, Shanghai, Shenzhen, and Tianjin. So that means you can also take a look on the map here. This is like China map, and you also see that like the darker colors for blue is mean the higher carbon emissions. Then the red dot means the 7 pilot zone in China. This is like 7 pilot zone, and we want to look at whether the firm are located in 7 pilot zone. Do they react? How they react to the kinds of risk related to diversification strategies. So that's the reason why we want to look at the second hypothesis. That means diversification can have heavy emitters in carbon trading scheme to access to the carbon finance, because they can sell their redundant emissions permit to the firms in need. So that's the reason why we look at the second hypothesis. That means the heavy emitters located in pilot carbon market, they experience the strong motivation to follow the revenue diversification after 2015 relative to the other firms in the other area. That's the second hypothesis that we want to look at. The third hypothesis means state interventions. So, state ownership in China, they mean the state ownership in firms, they have the higher impact on the corporate investment and decision making. It means if firm has like higher ownership related to the government, then they have like the state ownership. They can try to have the firm to obtain more investment or to improve the decision making of the firms. Then they also state ownership in China also stimulated the arrival of firm proactive to environmental strategies. Why? Because like the Chinese government, they want that the state-owned firms, they look like the model, the good models to the other firms. So that's the reason why we look at like China New Climate Action Plan might be better to transmit it to firm with higher state ownership, because they are the good model to the other firm to maybe to follow to state owner. So that's the reason why we look at like ceteris paribus corporate diversifications subject to Paris Agreement and more pronounced for the state-owner firms than the other firms. Let's go to corporate R&D, research and development. So the green technologies, they are the extensions of decarbonization and carbon productivities. So that's the reason why some firms, they need to reduce the carbon intensities as the law requests them. However, firm also, like corporate firm, they also need to be trade-off between R&D investment and diversification. So that's the reason why if firm, they are more innovative, they have the plan to adapt with carbon risk, then the impact of carbon risk on the firm with higher innovation might be weaker. So that's the reason why we look at the fourth hypothesis. Ceteris paribus, the impact of carbon risk on the corporate diversifications might be weaker if the firms, they follow the higher innovations. Then let's go to the last hypothesis. It means assets liquidities. So for example, assets, liquidity is the abilities that the firm they can liquidate their old assets and their old technologies. Then if they liquidate these kind of assets, they can use the resources to reinvest new projects. Then that's related to the highly silicos industry. So that means these firms into silico industry, they are more sensitive to negative demand shocks. Then these kind of firms, they have the lower assets liquidations values. This based on the current literatures. Then based on the current literatures, we try to form the fifth hypothesis that the impact of carbon risk on the corporate diversifications of heavy polluter, it means the firms doing business in the gray area have stronger with the higher degrees of assets liquidation values. Why? Because if the firm they have ability to liquidate the assets, so they don't have any motivations to diversify their revenue. So if they find difficult to liquidate the assets, then these kind of firms they might have the stronger motivation to diversify their revenue. So that's like our hypothesis. Can you still hear me? Do I speak a little bit fast? Or if you have any questions, please feel free to interrupt and ask me. So let's go to the research design. So that's the hypothesis that we form and we want to test then how we design our research. Then we will go to the data and methodologies. So we try to collect the financial data for the firms, the Bloomberg's CSMAR and Win database. We try to grow the macroeconomic data related to World Bank and our in-data macro trend database. We also use the economic policy uncertainty index. Then our sample already covered the periods from 2001 to 2017. We exclude the COVID-19 pandemic as well, the trade war periods, because it is also related to firm performance and also like the strategies of the firms. So in this study, we use the methodologies that we use the Paris Agreement and the YC natural experiment to investigate the carbon risk on the corporate diversification. Then we follow two ways to classify heavy emitter. Then we adopt different analysis and propensity score matching approach to make sure that our results are robust. So in the next slide, we will go to our main variable, especially like how we classify carbon risk. So there's two ways that we want to classify the carbon risk. The first one is we use the industry classifications. This means carbon risk measurement. So this is like nine GICS industry. For example, chemicals, construction material. This is like based on if the firm doing business in this industry, then we can classify that kind of firms related to heavy emitter. So based on 9 GICS industry and based on 5 S&P 500 sectors, then we will use dummy variable emitter as value 1 and not 0 for firm doing business in carbon intensive based on 2 criteria that I mentioned before. We also follow the study from Wing and Fang, also used like the event study to test whether the firms they react to the news of 30 June 2015. Why this day? Because this day is the day that China submitted the plan to reduce the carbon emissions. Then we look at cumulative abnormal return of Chinese stock, particularly Chinese firms in 3 days and 5 days in the window surrounding this event date. Then we also use the main criteria. If firm react negative cumulative abnormal return surrounding this day, then we classify that kind of firm as heavy emitter. Then we also estimate for dividend reinvested and dividend non-reinvested cumulative abnormal return. So from this slide to the end of my presentations, if you see the variable cumulative annual return for 3 days and dividend reinvested, then we try to classify our main variable with the different criteria to make sure that our results are robust. Then we note emitter as a main variable and other as sensitivity tests. Then we try to explain the higher carbon risk. It means the firms that are emitters and they receive the value number 1, and if not, is it like the value 0. So in our, we want to highlight what is like corporate diversifications. So what we try to estimate, we try to use based on the study of Dennis, Gu, and Huang, then we estimate the number of segments of the firm doing business. Then we multiply with the weights of revenue in these sectors with the numbers of sector constitutes of firms' revenues. And this index, they call an entropy index. Then the high entropy index means the higher corporate diversification is it like the literatures, quite solid literatures related to corporate diversification. Then this is like our main variable, like dependent variable. Then based on baseline model, we want to look at like whether the firm follow diversifications after the event date 2015 with the emitter, like the firm doing business in 9 industry or 5 industry based on the different classifications. Or we also look at like if the firm react negative return, then we also estimate based on the different and try to control not only for macroeconomics, but also for firm characteristic. For example, we try to control for firm size, leverage, financial leverage, always revenue growth, to P&Q, and the other like annual emissions of Chinese economy for macroeconomics, policy uncertainty, and also GDP in China, consumer price index, and also like unemployment rate. That means we try to capture from macro economics and also microeconomics related to the firms.
Sorry, can I quickly ask a clarifying question?
Yeah, feel free. Yeah, please.
Can you go on? Yeah, so you, with the entropy index, you start your sum from I equals 0. Does it mean that you have firms with 0 segments?
Mm-hmm. Yeah, actually I go with that's it, like if firm has no segment, then we have the entropy 0.
But from an economic point of view, how can a firm derive revenue from 0 segments? Shouldn't that be at least 1 segment, at least something?
You mean like the subscription here should be like E equal 1, right? Mm-hmm. So
I'm just thinking, what does it actually mean if a firm has no segments at all? Because it...
Yeah,
I think it might be a typo, and we will have a look back at it, but probably you're right, it should be I equal 1 in the subscript.
Okay, thank you.
Thanks a lot for pointing.
I have a question actually related to the entropy and size. So is it possibly still somewhat size dependent? I know you have a linear specification where you have firm size on the right hand side, but there could still be concerns that there's still some loading on this, that there's still some size left in that measure. Have you checked for other higher order firm size introductions or like nonlinear specs on firm size? Just to make sure that entropy is not simply size or partly size.
Actually, we did the correlation between the firm size and entropy, right, Anh?
Yes, yes, of course. We thank you for your question. Yeah, we did some check on the correlation between entropy and size, and it's going to be shown in the descriptive statistics. And we also have control for firm size in our models. So there one thing more that we also use the number of segments in our as a alternative measurements of diversification in our robustness test. So lately, Toan is going to show you the models and the result. Hopefully, that will answer the questions.
Yeah, thanks.
Okay.
Actually, we try. Yeah, thanks. Actually, we also look at entropy index and also like the number of segments to make sure that both results don't have like not different much, right? Let's go to the empirical findings. So the first way is descriptive statistics. So I don't want to put the table of statistics, but I want to to point some highlight that the descriptive statistics. This is like the table that we have more around like 9,000 observation, but I want to give some key points. The first one is on average, Chinese listed firms has around 2 segments. Then we also look at both entropy index and average firm segments. Then we also found an increase in both index after 2015. So can you see the figures here? You also, this is like the cutting point from 2015. Then the blue light means the entropy index also increased after 2015. Then also the numbers of segments also increased after 2015. So that means we also observed that both index increased after the event date. We also want to highlight some point that around 18.7% of firms observation belonging to the heavy emitting firms. That means we want to this index related to the classifications related to 9 industry. And if we look at 5 industry based on S&P 500, we found 27.6% of observation related to S&P 500 classifications. Then there's also 84% of observation in our samples subject to higher carbon risk than the others. Then we try to estimate the correlation matrix. Then on the road also less than 0.7. So that's no further issues. Only to the highest correlation is entropy and number of segments also earn the highest correlation at 0.81. Then that's we try to use this index to alternative measurement to make sure our results are robust. So let's go to the main findings. The first one I want to highlight is the univariate test. That means we try to test the mean different test for firm characteristic. Then we try to look at like heavy emitters and light emitter also here. Then this is like the differences. Then we also try to look at before 2015 and 2015 onward and look at the difference for heavy emitter and light emitter. So in this test, we want to highlight something. The first one we want to highlight is the entropy of the Chinese heavy emitter is generally lower than Chinese light emitter. Then the entropy index of Chinese heavy emitter increased after the announcement. That means after the announcement, Chinese heavy emitter, they increased the entropy index to adopt to the plan to 2015. Then the increase in entropy of the heavy emitter after the event is larger than the light emitter. So this is like heavy emitter, then this is like light emitter. Then we found like heavy emitter, they how can I say, like they have more strong motivation to diversify their revenue based on the entropy index. So that is the number just tell for the first line. So let's go further with analysis. This is the first baseline regressions model based on the test design are different in difference. So you can see we also estimate for the reduced form baseline with their fixed effect and baseline the convention with their fixed effects, then reduced form baseline with fixed effects, and with we didn't reduce, but we tried to estimate the full baseline model with the fixed effects. Then you also see the coefficients in the heavy emitters multiple the event date. That's all the coefficients are significant and positive. This means the heavy emitter, they tend to pursue diversification strategies after the event day that China submitted the climate action plan to UNFCCC. Then we want to confirm that the empirics support the first hypothesis that after the event day, the heavy emitter, they adopt the revenue diversifications. This is based on the baseline regressions result. We also estimate the different with matched sample. So what's the like matched sample here? We estimate by 2 steps. We matching steps and matching diagnostics. We try to match each of observations from the treated group, it means the heavy emitter, with the observations from the control group, it means like emitters, based on the firm characteristic. If the firm to have the similar firm characteristic, then we try to match their characteristic. Then the figure 3 in my slide also provide empirical evidence, the different analysis with matched sample. This means we also use the reduced form and full baseline model. Then all our regressions also consistent with the previous finding. This means the heavy emitter, they have the stronger motivation to pursue diversification, even we use baseline model, or we try to estimate with the matched sample. In the next slide, I also try to explain we want to use the alternative variable measurement, because as we mentioned before, that number of segments and entropy have the high correlation, and they are also the proxy to capture like the corporate diversification. So we try to use the dependent variable for number of segments and also the entropy index. Then you also see this is like the event and emitter. We also have the positive correlation, the positive coefficients significantly at 5%, and also the event multiple the top 5 emitter. That means we try to classify the firms based on the different criteria. This means based on S&P 500 criteria. Then we also obtain the robust result. That means although we use the alternative measurement, then our findings sensitivity to the are still robust. Then we also want to highlight that the heavy emitter firms, they diversify after the events. The results how robust after using the different dependent variable or using top 5 emitter. In the next slide, I want to highlight that in the previous slide, I also mentioned that we do not only classify the firms based on their how can I say, like based on their main industry work operation, but we try to estimate whether the firm react to the event that China submit the plan to the UN FCC or not. Then that means we have the 4 other heavy emitter classifications based on cumulative abnormal return 3 days with the dividend reinvested or non-reinvested. Then we try to use the different indifferent for the market reaction variable to classify the Chinese firm as the alternative measurement for the carbon risk. Then we also obtain the positive and significant coefficient across equation 1 to 4. That means the real response to the market return to the event China joining the Paris Agreement as a penalties for the heavy emitter also pronounced for this firm. Then we also found the robust result if we classify firms based on other criteria, not only based on the industry operations. In the next slide, I would like to explain the mechanisms. What is like the underlying mechanism behind the story? So the first one is diversification discount. So we try to split our data with equity firms. Equity firms mean firms without diversification discount. Then we also form the subsample with financial leverage firm. That means firms with diversification discount. We also obtain the positive and significant coefficient. However, the magnitude of both coefficients are different. So based on the highlights on the right side, you also see that means the diversification cost highs. It means the firm experience the higher cost. Then in the study of Mansi and Ref 2002, no evidence of diversification cost on the equity firms. And what we found here is we found the equity heavy emitters has the lower, it means the lower diversification cost. They have the fewer incentive to rechain the diversifications. Then that means we also draw the initial conclusion based on that the effects of two firms might be different based on the capital structures of the firms. This is related to diversification discount. In the next slide, we try to test the second hypothesis. That means the firms doing business in pilot carbon market. You also see the figures, number 7 here. We try to split all the firms to different groups. The first group is firm doing business in the carbon market zone and firm outside the carbon market zone. Then you also see the coefficients of firm doing business in the carbon market zone higher than the firm outside this area. That's the reason why we draw the conclusion that the intensive for Chinese firm in the carbon pilot market zone, they are more likely to pursue revenue diversification after the Paris Agreement than the other firm doing business outside this area. That means we draw the importance of the emission trading scheme to China. Then we try to explain that emission trading scheme as a good model to motivate the firm to diversify their revenues and also to go green. Then our empirical evidence support to the second hypothesis.
So, John, I have a question about the interpretation here, and also the interpretation later on when it comes to state ownership. I mean, you're going to say, you know, being in such a pilot carbon market, or if you are actually a state-owned company, you're more likely to do this, to diversify. But couldn't it also be that it's easier, less costly to diversify? Here in this case, maybe these markets are placed in a part of the country where there's simply a lot of diversification possibilities, and the same for state-owned companies, right? So maybe it's easier for them to do it.
Yeah, that's true. I mean, that's like some advantage. I want to admit it. That's like advantage for these types of firm. They have some easy to implement that strategy.
But it would be nice to try to disentangle, right? So whether or not they want this, or it's easier for them to do so. Maybe there's a way to try to disentangle this also for the state-owned companies.
Yeah, but Stephen, do you have any suggestion how? I mean, that's very nice.
Yeah. Thanks for turning the tables on me. No, I don't have an immediate suggestion. No, thanks.
Okay, thanks a lot. But actually, I will think how to distinguish, like, what is like their underlying motivation, or it's just like because like they are easy to do that. Yeah, thanks for comments on that. Then also we try to test the third hypothesis. That means we try to multiple event emitters and state ownership firms. Then we also look at full sample, and match sample. Then we also obtain the positive and significant coefficients across the regressions. Then we found out like the result indicates that the positive impact of that on state ownership are more pronounced on the firms. Then the role of ownership could be something very good to diversify and also like adopt, go green with Chinese firm. Then our empirical evidence support the third hypothesis. So let me go to the last channel before I go to the conclusions. So we have time to discuss and also talk more about these projects. So sorry, it's not the last, sorry. This is like the R&D, and the last is liquidation, sorry. We look at like another mechanism is like corporate innovation channel. By multiple with R&Ds, then we found that both coefficients here are negative. Then if the Chinese firm, they are doing R&D or innovation motivation already, so they don't need to follow the revenue diversifications anymore. So that's the reason why we found the effects seem to be weaker in the firms with the higher degrees of innovations. Then that is something we want to draw the highlights here. That means the importance of research and development as the alternative wave to diversification strategies. Then the last line in the empirical findings is related to assets liquidations value channel. So based on that, we try to use with industry level with investment irresistibilities and firms level investment irresistibilities. Then we also estimate for full sample and match sample. And then you also see both coefficients here also positive and significant. That means we draw three highlights below the tables. The first one is daisy and incremental effects of assets liquidations values of the firms after the Paris Agreement to follow the diversification decision making in China. Then the heavy emitter, they face more friction to liquidate the assets. And if they liquidate the assets, then they can, invest in the carbon intensive technologies as the carbon risk increase. Therefore, they resort to diversification strategies. Then our result supports for the fifth hypothesis. So this is like the last slide for empirical findings. Then I will go to the conclusions. I just have the fourth slide and we can spend a lot of time to discuss. So how our paper can contribute to the current literatures. The first contribution I would like to mention is, this is the first paper, as far as I know, contribute to the embryonic literatures on the firm behaviors on the context of environmental degradations. So the other study, they look at firms' performance, they look at firm leverage, they look at like the compensations of the investor. This is the first study look at on strategies of the firms, like firm follows the diversification in their revenues. Then we provide the novel findings on corporate diversifications when facing a higher level of carbon risk. We try, because like the current literatures, they'll look at like Kyoto Protocol 1997. However, the understanding of Paris Agreement are quite limited. So our paper at understanding of Paris Agreement, then we have to admit that the Chinese firm, they're very clever to diversify their revenues, and Chinese government, they really committed to the Paris Agreement because they, what I want to say, like they want to earn the reputations in the international accord. Then they strictly respond to the firm that we need to reduce the carbon emissions. So that's the reason why I would like to say that it's quite very interesting to see that like China, they have very strong motivation to reduce the carbon emissions. The number 4 contributions for this study is we also explore the potential channel driving the diversification strategies of the Chinese firm with the state owner, also like R&D innovations, and also with assets liquidations. Then the study has several implications for policy making and corporate strategies. So what is the implications for this study? The first implication for policy making in China is like, actually, we found that like the firms in the emission trading scheme, they diversify more. Then that's the reason why we propose for the government policy that if they have any policy to promote the trading emission trading scheme as well, easily to liquidate their assets, they very supportive to heavy emitter firms to decarbonize. We also found like the mechanism of state ownership. Then that's it, like the Chinese firm, they can transmitting climate policy to heavy emitters via state ownership. But actually, I think that like we need to distinguish whether their motivation are just easy to do that. Then also, the third policy making point that we want to draw here is like the government, they should support to corporate green technologies. Then implications for corporate strategies of the heavy emitters. That means the firms, they should focus on R&D because we also found the negative coefficients of R&D. Then if the firms, they are focused on develop and research to green technologies, this is a more sustainable way to deal with the carbon risk when China adopt to reduce the carbon emissions. Then the last point for corporate strategies is firm can ventures to newly available greener investment option as alternative green, but is a like quite risky R&D. Then this is like our paper and also like short presentation for the seminar in 1 hour. I think that like we still have 10 minutes. So if you have any questions or comments and feedback, please feel free to unmute and say something. Thank you very much.
Thank you very much, Toan. Thank you for your presentation. And yeah, let's open the floor up for questions and start the Q&A. So just, you can also make on your video, and we have a little bit more chat about this interesting research topic. I think you're muted, Toan.
So should I stop sharing? So that way
you can as you like. You can also like stay, let it a little bit stay there, and then maybe somebody has a question on the slides. Yeah, as you like.
Yeah.
anybody from your audience has a question.
Hey, can you hear me? This is Anne Beck speaking. Thank you very much for the very nice presentation. Super interesting topic for sure. I was wondering for the different setup that you're using, whether you also conducted, I don't know, the regular checks for pre-trends, because if I remember correctly, you had that the high emitters in the pre-period tend to be a bit less diversified in terms of the segments that they're operating. So are you afraid that there's just a little bit of mean reversion going on? So they're just in general becoming a bit more diversified. And when you also showed the graph of how the average entropy index was evolving and the number of segments, it looked a little bit to me as if there would already be some pre-trend going on before 2015. Yeah, so just wondering, I don't know, how would the regression result look if you would just arbitrarily set the Paris event in 2013 or something? Yeah, have you checked something like that?
Yeah, thanks a lot. And can you please correct me if I make any mistake? Actually, we try to shift the event before 2015 and after 2015. Then we do not find any significant result anymore. Then, but actually, I know that like you wonder for the pre-chain analysis, but I'm just wondering if we can ask, because like we don't have like dynamic event. We only have like one fixed event in 2015. So, but actually, I
guess like running just the event at different dates is already really helpful. I mean, something that you can do is just run kind of a regression with like the effect T-3 and then see whether you have differences in the treatment group versus the non-treated. But overall, really interesting results and good policy advice.
Thank you. And actually, we have some tests, unreported tests, checking the unparalleled trends for the assumption for the different analysis, and it turned out quite satisfactory for us. And we see that our analysis quite meet the requirement for different analysis.
Great.
Yeah, thanks.
Thank you.
Yeah, thank you for the question. Are there more questions for the speaker and the co-authors who are also thankfully in the call?
Now that we're at the technical questions, I was wondering about the propensity score matching. Did you do sort of a quality of match check? I assume you did, but you didn't mention it, or in case I didn't see it. So
propensity score matching.
Yeah, we do some matching diagnostics. For example, the probit regression on the pre-match and post-match samples, and we turn out that I think, let me share the screen for a moment. Is that okay?
Yeah, please.
All right.
Yeah, it seems to be have been there in the slide. Sorry, I missed that.
Sorry, can you grant me the right to share?
Yeah, one moment.
Thank you.
I think you should be able to now.
Okay.
All right. So thank you. This is the screen for our diagnostics. And you see we match on the firm characteristics like firm size, leverage, profitability, for cell growth, and turbine kill. And in the pre-match sample, we have all the almost all the variable significance. However, in the post-match samples, for the probit regressions, on the firm characteristic variables, coefficients become insignificant, and also the pseudo R square, it reduced significantly after the matching procedures. That means we match postmark samples, I think it's quite, suitable for the outcome of the propensity score matching procedures.
Thank you.
So hopefully that, yeah.
Thank you, looks good.
Yeah, right. And right, thank you for the questions.
Yeah, thanks.
Are there any more questions? I think we have another 4 to 5 minutes, so feel free to jump in.
Maybe one more question on external validity. So here you have this really nice setting with China that you're focusing on. How do you think do your results apply to settings in other countries? Because I mean, China, as you also mentioned, has really this strong focus now on becoming more sustainable. So do you think, yeah, something similar would also apply to other settings?
Yeah, thanks a lot for your questions. Actually, I think that like maybe we can expand this study to international, right? But why? Let me explain again why like China. Why I want to look at China, because like it's not easy for firms to adapt to the Paris Agreement immediately after the submissions to the like to commit it, right? Then we found that like Chinese firm, they have the revenue diversifications. Then, but actually, there's one thing that I want to highlight. If the results are more interesting, if we know that like the firms, they diversify to greener industry, or they diversify in, let's say, like rare industry. But actually, like we love to have the result. Then what we can apply for the international, like the other settings, like the other countries, this means firms, they, of course, they can follow to diversify, but the way that they diversify is very important, more greener or more grayer. That means we need to have like the, how can I say, like more clear data to distinguish the problem. That's in my opinion. So my co-author also have like some point to supplement.
Thank you, Anne, for your question. I think that is quite interesting because yeah, there's the international sample might also have point out some other stories, because the setting is quite different between countries. China is the largest emitters in the world in terms of like greenhouse gas emission, right? So that is the unique settings of China's, and also China's have a different social political setting compared to the other countries. The more similar should be Vietnam. However, we do not have any data do not have enough data for Vietnam, and also we are also thinking about doing some international study related to these studies, but not quite close to diversifications, maybe in investment or R&D properly. So that is our thinkings and our plan for the topic with the international samples. And thank you very much. Hopefully there will be some opportunities for us to show, to present out a further study here with you.
Thanks, great. Yeah, very interesting.
Yeah, thank you.
Yeah, thanks.
Yeah, thank you very much. I think we are at the end of the official part of the seminar, and I really want to thank you, Toan, our guest speaker, and also Kan Wan, who also joined. And yeah, it's great to have you. It was great to have you here. Yeah, we will continue in the unofficial part after I stop the recording. However, next week we have another session with Silvia Dalla Fontana, with your project Green Innovation. So also looking forward to see you there. And yeah, otherwise take care and hopefully you stay a little bit longer.
Yeah, thank you very much.
Thank you. Thank you.